Welcome back to the Finance Feuer Talk. Hard assets versus tech innovation. Joining us are MB Capital Strategies and Augtopo.
Hi everyone, Augtopo54.
Without hard assets, there is no tech future. We talk a lot about software, AI, and digitalization, but every one of these developments needs a physical foundation. Energy, metals, transport, and infrastructure. Tech is visible and scalable. Hard assets are invisible but indispensable. It's precisely this invisibility that leads to them often being underestimated on the stock market. Yes,
Modern technology, I think, tends to scale at a much faster rate and also consistently outperforms other investments in the long run. And that is exactly why it is significantly more valuable than just these traditional physical hard assets.
I deliberately focus on hard assets because they deliver real value creation. Not on paper, but in the real economy. Energy is produced, raw materials are extracted, goods are transported. That's not a story, that's reality. Many of these sectors are currently massively undervalued because they are considered cyclical, old-fashioned, or politically challenging. But that's exactly what creates attractive entry prices. A key point is cash flow. Hard assets generate ongoing income. And that's today, not just in some perfect future. This cash flow provides time, peace of mind, and flexibility, even and especially during volatile periods. And bottlenecks here are not a disadvantage, but an advantage. When supply cannot be expanded at will, structural scarcity arises, leading to long-term pricing power. Yes,
Wait. When we talk about technology, for example, which I personally much prefer, we're not just talking about classic software apps or about stock market valuations. Today, technology is the central productive force in every industry, including traditional hard assets. Whether it's energy, raw materials, shipping, or whatever else, without data automation, AI, and IT infrastructure, none of these industries would be competitive at all. That's why I see it clearly. The core message is that technology is not a separate sector. It permeates all other areas. And in the same way, hard assets are gaining ground. They are becoming more important precisely because of technological innovation, not in spite of it. And that's why technology is just super cool.
for me, copper is the perfect example. The energy transition, grid expansion, charging infrastructure, data centers, and AI. All of that is extremely copper intensive. At the same time, supply is extremely sluggish. New mines take 10 to 15 years. Permits are complex, ESG requirements are very high, and the capital investment is enormous. Even if investments are made today, new supply will only come online, far too late to meet demand in a timely manner. This is not a short-term cycle, but a structural supply problem. When demand rises in the long term and supply can hardly react, real pricing power emerges. And that's not wishful thinking, that's simply the logic of supply and demand.
Okay, so those were your arguments for the hard assets, as I understand it. Correct. Then let me give you a counterpoint right away. So I see problems here in the fact that hard assets are cyclical, subject to regulation, capital expenditure heavy, and pose political risks. So I'd like to elaborate a bit further on that. Regarding the high cyclicality, it's simply that revenues are highly dependent on global supply and demand cycles. Companies can hardly control or influence this, which is a significant disadvantage in this asset class. Prices are set by the market, not through differentiation or pricing power, but by the market itself, depending on how much demand there is for the assets. Boom phases often lead to overinvestment, which can later trigger crashes. The classic commodity cycle. At a certain point, there is strong demand for specific raw materials, and eventually you end up with an oversupply if too many mines are exploited. And then prices fall again, which is very negative. Just a quick note on regulatory interventions and political control. We have strong regulation and by now also a lot of overregulation. You can see it from the EU as well with all the laws coming in, environmental regulations, safety standards, ESG, everything that goes along with it. There's quite a lot, possibly even price caps, tariffs, and so on and so forth. Of course, this also leads to political conflicts of interest, such as energy prices versus climate protection, which are hotly debated topics, and many risks where it's unclear what tomorrow's regulations will look like. everything could be completely overturned at any time, for example, with the next US president. And there's also the issue that governments like to actively intervene in markets. We see this very clearly, for example, with the USA, especially right now. You can see just what is possible when a president no longer adheres to international rules. And particularly the high capital intensity, in other words, this capex heavy nature, is evident in the enormous upfront costs involved. So if a hard asset company wants to launch something new, for example, then exploration has to be carried out. If you want to operate mines, you have to look for where to find the right new mines. You have to conduct core drilling to take samples. You have to build facilities, set up all the logistics, and construct pipelines. A lot of energy is needed. That costs quite a lot of money, and the payback period that comes with it is quite long. There is also the risk of a mislocation, that you invest in a mine and you think you can extract a lot of raw materials there. And then when you're in the process, you realize, damn, there actually aren't that many raw materials in that mine after all. And then you end up having some problems again. And regarding political and geopolitical risks, it's quite clear. Topics like trade wars, sanctions, national interests, which always lead to problems, things like sea and trade routes that you have to be careful about, geopolitical power blocks that exist in the world and are constantly shifting. What may seem like secure logistics right now can, in just 1 or 2 years, be completely disrupted by problems with individual countries. So you never have 100% security. There are always huge risks. A lot can always happen. Yeah, that's my counterpoint to that. And I think now we can move on to technology, which I personally find super exciting. So technology. Technology is really cool because it brings innovation, productivity, high return on invested capital, and global scalability. I'd like to elaborate on that in more detail. So technological innovation serves as a lasting source of value for exponential growth. So you really have the advantage that you don't grow linearly, but can actually grow exponentially. That's because the innovation is endogenous. It arises continuously from research and development, from the company's own data that is collected and analyzed, and from that, products are developed, as well as from user feedback and software iterations. So you build software, technologies. And it is important to remember that you don't simply do it once and then it's completely finished. It functions very much in the same way as it does with physical hard assets, for example, in the mining industry, where a specific operational process is established and set up, and then you mine underneath it. But with software, the technology really continues to evolve and change over time. Agile, step by step, always moving forward, always progressing. Accordingly, you can keep growing, becoming bigger and bigger, and get more and more out of a single product. And new products can expand and redefine existing markets. For example, you can see this in businesses like cloud computing. Cloud, it's a product that was started once and then rolled out everywhere. By now, it's become the basic infrastructure for many companies. It's the same with AI or platform economies. Super exciting things like how a cool technology that you develop can suddenly can change the entire business world. And then it becomes a lever for productivity instead of just volume growth. It's very clear with technology, we have the opportunity to achieve massive increases in production through automation that is driven by technology, through AI, since AI automates decision-making processes. So you no longer have to rely on a person to check something, but you can accelerate the whole process much faster. Digitized in every company, processes that also simplify everything and make it more efficient. This way you generate significantly more output with the same or even less input, thanks to these efficiency gains that technology brings as an industry, and productivity increases as a result, regardless of the availability of raw materials, because technology simply provides a certain level of independence, especially when we're talking about software. The high and sustainable returns on invested capital, which I already briefly mentioned. I just want to quickly point out that in technology, it's simply the case that you have high fixed costs, of course, due to research and development. When you want to build new software, there are a lot of things you have to pay attention to. There are also a lot of regulations to deal with, and you have to set all of that up. But as soon as software has been developed, the marginal costs are basically close to zero. That means you can then provide finished software to additional customers quite easily without incurring extra costs. because once such software or technology is finished, it can actually be copied quite easily and then resold to the next customer. This makes it especially easy for technology companies to generate disproportionately high profits with each additional customer. And of course, recurring revenues from subscriptions and licenses also give you the opportunity to keep earning a lot of money quickly without much additional effort, which is different from mines, because if you want to open up a new mine to generate more money, you actually have to develop an entirely new mine. That requires a lot of investment again. With technology, it's much easier. Ultimately, it's just copying code. And the global scalability without proportional capital commitment, let me just quickly emphasize that again. So products can be rolled out globally without any problems. If you have a technology, as I just mentioned, it's simply code that you can copy and provide to any customer. To put it bluntly, that's why the costs are much lower when offering a technology. Expanding into the broader market, even on an international level, that gives you a huge scaling advantage. Yeah, I hope I didn't overwhelm you with all the amazing, cool advantages of technology.
It was definitely quite a long list, but you also gave me a few prompts there, of course. On the topic of data centers, as we now know, pipelines are even being laid to data centers, or even nuclear power plants are being built next to them, so that data centers, especially in the AI sector, can even operate at all because they are simply very energy intensive. Just to briefly add that to the topic. Now, you've really given me a lot of counterpoints here. Now, I'd just like to say briefly, then I guess it's my turn to start.
Now I'm going to get my share too.
Of course, I want to make one thing clear. I'm not against tech or innovation. My critical point is the valuation. Many tech companies are valued as if there were no capital costs, no cycles, and no disappointments. That means we have very high expectations regarding real capital costs here. There is a risk of multiple compression. The risk doesn't lie in the business model, but in the expectations. And that's exactly what we're seeing. Among other things, and of course this is not investment advice, for example with Nvidia, and especially with all these tech companies that have such massive expectations placed on them, which they ultimately always have to meet. Even small disappointments can trigger major price reactions. With hard assets, it's often the other way around. Low expectations, real cash flows, and tangible assets. That, to me, is the difference between narrative returns and cash flow returns. So I'd just say, let's wrap this up with a conclusion. I'd say, Octopo, you're welcome to start.
Yes, well, actually, it is less of a simple either-or choice and much more a question of our overall approach. And of course, from my perspective, for me personally, currently my focus is more on tech to benefit especially strongly from scaling and excess returns. That's naturally what I prefer at the moment. Of course, now my personal approach and my personal investment goal, I think, are naturally also just for me personally. Super exciting. That will probably become more interesting for me later on when I start focusing more on the dividend strategy. We already discussed that quite thoroughly in the last video. That's when I would probably consider it more seriously. Currently, my personal approach is mainly focused on scaling effects, and that's where I personally really like to invest more in technology.
Exactly what's crucial are the cycle, valuation, and of course your personal goal, which we often mention here as well. A mix can make sense, but tech and hard assets play different roles in a portfolio. If you understand that, you don't have to commit ideologically. The future is digital, but it will be powered by energy, infrastructure, and energy, and built with metals. Of course, this video was not investment advice, but just our personal opinion. Thank you very much for watching. If you haven't subscribed yet, we'd be happy if you do so here, and feel free to leave comments as well, because we look forward to every interaction, I would say, or update.
And by subscribing, you can really support us. As support, we would really appreciate that too.
That would be it for the recording. I'd say we'll see each other then in the next video.
Next time,
Until then,
ciao, ciao.
bye.